Geopolitics and Interest Rates, by Zoltan Pozar, Global Head of Short-Term Interest Rate Strategy at Credit Suisse. So Zoltan will be joining us, from New York, and the session will be led by Meneka Doshi, the senior journalist and editor. She'll be, virtually joining us from Mumbai. So both of them do not need any introduction, and I'm sure you guys, cannot wait to hear both of them. So we're going to go live, and I'll catch you on the other side of the discussion.
Ravi, thank you very much for that introduction. Please forgive me for the few seconds of lag between him introducing me and me being able to take over. That typically tends to happen in virtual events. Thank you very much to the CFA Society for inviting me to be here today. Because Zoltan Pozar is someone that I've followed closely over the last many years now, especially his notes, which have now become, matter of cult status, if I could say that. So a very warm welcome to all of you at the CFA Society and in the audience. And now let me introduce our key speaker for the evening. Zoltan Pozar is investment strategist at Credit Suisse, but that would be a rather narrow description of why he is considered amongst the most noteworthy financial and economic thinkers and commentators currently. Why he even has his own social media hashtag, as a Financial Times article recently noted. Now, Zoltan has had a ringside view of central banking, regulation, and global multilateral institutions, along with financial markets and economics. Before joining Credit Suisse, he served as a senior advisor to the US Department of Treasury. And before that, in 2008, he also worked at the Federal Reserve Bank of New York, where he was deeply involved in the Fed's response to the global financial crisis. He's worked at the IMF and was involved in framing the fund's official position on shadow banking. Now, that's an area of expertise that has earned him quite some renown. He's also at the IMF consulted G20 working groups. He is a founding member of the Shadow Banking Colloquium of the Institute of New Economic Thinking, INET. Now, this varied experience, combined with his study as a macroeconomist, has meant that Zoltan Pozar can join the dots in financial markets and the global economy to draw a picture that very few can see. He joins us today to do just that. Welcome, Zoltan, and it's over to you.
Thank you very much. It was a very, very nice introduction, very kind introduction. Yes, so my plan for today is to speak to you for about 30, 40 minutes, and then we can do a good round of Q&A after that. I would like to make a few remarks about inflation, the nature of inflation today, how we should think about inflation, as opposed to how the market thinks about inflation. What is the Fed going to do about inflation? The short answer is there's not much the Fed can do, but they will still try very hard. And then in the third part of my remarks, I will talk to you about what I think we will have to do to get inflation under control. And that's going to involve reshaping the world trading system, supply chains, the geopolitics of commodities. And then I will conclude with a few thoughts about what this means for countries that are not in the G7 club. What it means for China, what it means for India, and countries in the global South. So that would be the plan. So let me offer a framework for you to think about everything that is happening today. Let me start with the observation that money has 4 prices. These 4 prices of money are par, interest, foreign exchange, and the price level. So what do I mean by each? Par is, the price of money in the sense that currency in your pocket or money that sits in a commercial bank's reserve account at the central bank, or money that sits in your account at JP Morgan or your account at Citibank or your account in a money market mutual fund, these are all the same. They are supposed to be the same. You know, the value, the exchange rate between each and every one of these is 1. So that's par. When you need to transact with that money, you know, if it's 100 in your pocket and 100 in your bank account, you know, you expect to trade $100 worth of liquidity. So that's par. Interest is simply money today versus money tomorrow, money 10 years from now. When you think about interest rates, there's many different types of interest rates. You know, the central bank policy rates and expectations for those central bank policy rates are probably, you know, what everybody thinks of as the benchmark interest rate. In any country that you go to, that's going to be the case. This is what financial market professionals refer to as when you plot these interest rates, you will plot them along what's called the OIS curve, a yield curve that's indexed to an overnight indexed swap. And then there's many other interest rates depending on whether you're a bank that has to borrow, whether you are the US Department of Treasury, whether you are a corporation, whether you are an individual, you will all be paying a spread relative to this OIS curve. Then there is foreign exchange, which is basically one form of money versus another. So there is going to be an exchange rate between the dollar and the rupee, the dollar and renminbi, the dollar and the euro and the yen. This price of money moves obviously up and down all the time. It's determined in the spot FX market. And then the last price of money is the price level, which is just, you know, what money buys in terms of, let's just say commodities or any other basket of physical goods and services. So before we get into current events, the important thing about this framework that I just gave you, the 4 prices of money, is that when it comes to par, interest, and foreign exchange, these are purely nominal constructs. You know, these prices are all determined on the balance sheet of financial institutions. And when these prices break, it's very simple to fix these breakages because all you need to do is you need to inject liquidity into the financial system. If you are a central bank, all you need to do is put your balance sheet on the line and you can enforce whatever prices you want to enforce. However, when it comes to that 4th price, the price level, you know, the price level is where the nominal world and the real world meet, okay? Because when you think about a crude carrier, or when you think about a dry bulk vessel, or if you think about a container ship, whatever stuff is on that ship is going to have a nominal price, but what's getting shipped is real stuff. And when supply chains get clogged up and geopolitics starts to mess with things and straits get blocked, you know, the value of these real goods can go through the roof and the nominal price is going to adjust. But central banks can't really do much about policing these things. So that's the framework. So keep in mind the 4 prices of money: par, interest, foreign exchange, and the price level. So let's get into the present. They used to say before interest rates started to go higher that Wall Street and financial market professionals, for that matter, in any country, are so young that they won't know how to trade increasing interest rates because they haven't seen increasing interest rates for many decades. I mean, you would have to be a financial market professional that has been sitting in a seat since the 1970s to have had experience what it's like when interest rates are going up structurally. I think a version of that concern is that the financial market as a whole doesn't really know how to think about inflation. Because just as we haven't seen rising interest rates, we haven't really seen rising inflation rates for many, many decades. To be specific, we haven't seen that for 50 years. We basically were all, quote unquote, children that grew up in a disinflating world. I mean, if you think about the 1980s onward, inflation was becoming lower and lower, becoming less and less of a problem. In fact, the problem was that we were fearing deflation, and that's precisely why we have been printing money since 2008, since the great financial crisis, when QE policies have started. So, the first observation I would make about inflation is that inflation tends to be generational, or the opposite of inflation, deflation, also tends to be generational. And it just so happens that whoever was born in the late 70s, early 1980s, is someone who grew up in a deflating world. I was born in 1978. I know nothing but lower and lower inflation and stable prices. Probably most of you are in the same shoes. But now we are at the beginning of a completely different era. Inflation is an issue, and I think it's going to be an issue for at least another decade. So there you have it. You have to think about inflation and deflation cycles as something that's generational and long-lasting. And that's not what the market is doing. The financial market professionals today have all been shaped, their thinking has been shaped by the crises that they have lived through. So again, me, just like you, just like most of you, what were some of these formative experiences when it comes to financial markets? For me, the first, formative experience was the Asian financial crisis. It's 1997. Linking things back to the framework that I just gave you, 1997 was a crisis of interest rates because Southeast Asia had pegged foreign exchange rates, and the assumption was that FX rates are what they are. And then those FX rates broke because countries and banks in the countries that had pegged FX rates, they ran out of FX reserves. And when those FX reserves got depleted, these countries couldn't defend their exchange rates. And the pegged price collapsed, and it caught up with a shadow market price of foreign exchange. So there was a basis between the peg and the actual market price of foreign exchange. Then 10 years later, you've had the great financial crisis. That was another crisis where a basis opened up between things that were not supposed to have a basis. AAA treasuries were assumed to be, AAA CDOs and anything backed by subprime mortgage-backed securities properly structured were assumed to be the same thing as AAA treasury securities until the crisis came, and then a basis opened up between AAA treasuries and AAA CDOs. A few years later, something similar happened in Europe. It was assumed that Greek debt is the same as German debt, until the Greeks ended up with having too big government deficits, and then a basis opened up between Greek government debt and German government. And then fast forward to March 2020, when the COVID pandemic started, and basically every country, every corporation in every major country, whether it's a manufacturing sector or industrial sector or services sector, drew down their credit lines from banks all at the same time. So, this is something that the BIS has referred to as the great overdraft. The banks were just not liquid enough to provide all this liquidity all at once. And the financial market seized up as a result. We didn't really have a risk-free curve because basic relationships between futures linking to treasury securities and the physical US treasury market broke down. And so we didn't really have a risk-free curve. And if you don't have a risk-free curve, you don't know how to price risk assets. And there you had this big asset price meltdown that we've had in March 2020. Again, I'm mentioning these to you because these were the crises that shaped our thinking about crises. This is very important to keep in mind because the response to all these crises was interest rate cuts and liquidity injection by central banks and multilateral organizations like the IMF. You know, in 1997, the IMF poured a lot of money into Southeast Asia to stabilize. In 2008, we started to do QE in the United States to buy mortgages and treasury securities. During the European debt crisis, the ECB started to do QE to normalize spreads between Germany and peripheral Europe. And then the pandemic hit, you know, we did the mother of all QEs to, you know, put foam on the runway and liquefy the entire financial system. As we did these, all these bases that crept in, fixed exchange rates, market exchange rates, AAA CDOs, treasury securities, German debt, Greek debt, the cash futures relationship between treasuries during the early phases of the pandemic, these were all closed quickly and easily because it's all a nominal thing. It's very easy to fix nominal dislocations, right? All you have to do is print money and put your balance sheet on the line. Today, we have another basis dislocation that we are dealing with, and that's inflation is, that's basis dislocation. The way you want to think about it is basically you have a 2% inflation target if you're a central bank, and actual inflation is running at 8%. That difference between target inflation and actual inflation, 600 basis points, it's pretty big. That's a basis. And again, the market assumes that this spike in inflation charts is just like another basis dislocation on your Bloomberg screen. All that central banks are going to have to do is just the opposite of what they have done in these other crises. Today, we have to raise interest rates like Paul Volcker did, and we will have to shrink balance sheets, and inflation is going to go away. That's kind of the assumption. So, as I said, you know, inflation and the whole price level thing is where the real and the nominal world meet. The real world has to cooperate with inflation coming down. The crisis we are living through in terms of, you know, this inflation crisis is nothing like what we have seen even in the 1970s. I mean, in the 70s, you had an oil price shock. Today, the picture is far more complicated. I mean, the energy price shock that we have is not just oil. It's also natural gas, and it's also just electricity more broadly if you're in Europe. We have a crisis of supply chains. We have a spreading theme of resource nationalism. We have, you know, a set of technology sanctions. We have, you know, zero COVID policies in the factory of the world. So, you know, I mention these things because we have labor shortages, right? So when you think about the nature of the 1970s inflation crisis, that was a supply shock of oil, okay? And today you are dealing with supply shocks on three fronts. You have the supply curve for labor that shifted inward. You have a supply curve of all commodities imaginable. Okay, we will talk about this in more detail in a couple of minutes. You have oil, gas, copper, coal, whatever, what have you. I mean, we haven't invested in commodities for a decade, so supply is extremely tight. We have a supply shock coming from there, and we also have a supply shock in terms of cheap goods coming out of China, partly because of zero COVID policies, partly because of other things. But this is the mother of all supply side dislocations. So when you think about that inflation crisis we are living through, you know, do keep in mind, one of my most important messages today is that central banks are very good at curbing demand. Raise interest rates, raise the cost of money, that reduces demand. But today's inflation is not about too much demand relative to supply. Today's crisis is about massive inward shifts on the supply side of the global economy. And demand is central banks are trying to bring demands down to kind of keep up with these inward shifts in supply. But again, this is not a business cycle. You know, business cycles are steady supply, too much demand, let's slow demand down to the level of supply. That's a business cycle. This is a perfect storm on the supply side, and so we need to deal with it, okay? And so I mention this because when it comes to crises of par interest and foreign exchange, it's very easy. You just print money and you fix these dislocations. But when it comes to this crisis of price level, it's very, very difficult to deal with this if you're a central bank. So that's the first set of my remarks. Second, central banks, what should they do? You know, there's a very simple kind of cartoon version response that financial markets are running with. You know, they point to Paul Volcker and say, well, look what Paul Volcker did. I mean, all we have to do is raise interest rates and shrink the Fed balance sheet, reduce the quantities of money in the system, and we'll deal with this. What couldn't be simpler? All we have to do is be Paul Volcker. So let me offer a few observations about Paul Volcker and his achievement. Paul Volcker was a legendary central banker. You know, no doubt he raised interest rates very aggressively because he changed the operating framework of the Federal Reserve, and interest rates have gone from 2% to 20% practically overnight. No doubt that killed the interest rate sensitive parts of the economy, like housing. And you know, the housing sector going into a deep recession as a result certainly contributed to that very deep recession that was caused by higher interest rates. And I think that's basically the wisdom that we received from all these economists that wrote academic papers about how the great inflation in the 80s and late 70s was curbed. Keep in mind, the same economists that tell you that all it's going to take to curb inflation is to raise interest rates aggressively are the same economists who abstracted away from dealers and market makers before 2008. I mean, if you are old enough like me, I'm 44 years old, but it's getting there, you know, before the great financial crisis, economists were abstracting away from dealers. They just said market liquidity is something that we pull out of thin air. You know, the fact that we can transact in liquid markets, buy and sell securities, buy and sell currencies, that spreads have relationships that get enforced, you know, cash treasuries don't get too cheap relative to OIS, all these things, is because of dealers, because somebody sits there that makes two-way markets. I buy, you sell. If nobody buys or nobody sells, I will accumulate an inventory. I go either long or I will either go short. And all that depends on people. It depends on confidence, and it depends on companies having balance sheets to do these things. And so when we ended up in the 2008 financial crisis, there was no capital, there was no balance sheet, there was no trust. And so this whole two-way market making between dealers and their customers broke down. It froze, it came to a standstill. And so economists before 2008 were abstracting away the real aspect of market liquidity, what makes it tick. The same economists today are telling you that all it's going to take to curb inflation is to raise interest rates. And they completely abstract away from the real world. Things like supply chains, war, resource nationalism, very tight commodity markets. So let me tell you about how the real world looked like for Paul Volcker. A second important message today is that Paul Volcker got lucky. Paul Volcker got lucky because by the time he became a Fed chair in the late 70s, early 1980s, and did that aggressive interest rate hike, he was already benefiting from a decade of investments in oil and gas fields. You know, the initial OPEC price shocks which happened in 71 and 73 sparked an epic round of investments in oil and gas exploration. This is the period when the North Sea oil fields in the UK were developed. This is the period when the Norwegian Sea oil fields were developed. And this is a period when, you know, Canada and the US invested a lot in oil and gas fields. And so, by the early 80s, these big investments and this extra supply of oil that was coming out of these investments was reaping benefits already. So when you look at oil price dynamics in the early 80s, oil prices collapsed, like fall by 90%, because there is a recession that Paul Volcker generated, but also because a lot of new oil is coming on the market, and so prices collapse, and then that helps inflation a lot. The second thing that has happened in the real world is that the politics of wage setting and the power of unions started to weaken dramatically, starting in the early 80s. In 1981, it's not that I remember because I was in diapers. I was 3 years old, actually. I was out of diapers already. But I remember taking my first macro class and reading from the Beck, Fisher, Dornbusch macro textbook, which probably many of you have also learned from. There's a chapter there about President Reagan firing air traffic controllers in 1981 because they dared to go on a strike. I mean, today, anywhere you look in the Western world, people are striking as a national sport. Okay, instead of firing striking people, you have a labor advisor in the White House that is actually encouraging unionization at companies like Starbucks or Amazon. And every time you have a labor dispute, either at the Port of Los Angeles or if you have a labor dispute in the railway system of the U.S., the White House steps in and sides with labor, securing them a nice big wage hike. And then you have on top of this, things like student loan forgiveness, which is cleansing people's balance sheets so that they can borrow more and spend more. I mentioned these two things, Paul Volcker's tailwinds when it comes to fighting inflation in terms of oil prices collapsing and the White House helping the inflation fight by clamping down on unions and basically ending the practice of wage price indexation. These were two extremely important things that have happened in the real world that the Fed had nothing to do with, that helped inflation slow dramatically going into the 1980s. Today, as I alluded to this earlier partly, the picture couldn't be more different. Today, we are basically starting a period of high inflation after a decade of no investments in oil and gas, or for that matter, any other commodity. Because commodities are a dirty industry. Commodities are a dirty industry. It was not compatible with ESG policies. And most capital went into growth stocks like Amazon and Facebook and Twitter and all that stuff. So that's where all the capital has gone. It's not gone into commodities. So the capacity in commodity markets is tight. This is the year when demand for oil, for example, for the first time surpassed production in a spot sense. We consume more oil than the oil we produce. The reason why we haven't seen oil prices go through the roof, despite the conflict, despite everything, is because we have massive releases from strategic stockpiles in the United States and other advanced countries, and because China is in a lockdown. Okay, the economic dragon is asleep at the moment. But despite all these things, you need to keep in mind that demand exceeds production. So if the strategic oil stockpiles go empty, and if China reopens, we have a problem. Oil prices can go vertical. Oil prices can go to 200 from 100, despite recession fears and all that stuff. Because again, what matters is not what demand does. What matters is what demand does, and then what supply does. And even if you fall into a recession, supply can fall much faster than demand, and then prices go higher. And the same is true for, coal. The same is true for copper. A bunch of other commodities. And then the second thing is that we have a serious labor shortage everywhere in the Western world. partly because of entitlement, partly because of COVID, partly because reduced global labor mobility, partly because of politics, Brexit, you know, President Trump's anti-immigration policies, which we are still dealing with the consequences of. And on top of it, as I said, you know, we have a government in the US at least, which does not shy away from encouraging unionization and is siding with labor. This is a very different backdrop from Paul Volcker's backdrop. So Jay Powell thinks he's Paul Volcker, but I think is actually more like Arthur Burns, the guy that came before Paul Volcker. So what does this mean for the Fed? I think the Fed's task is hopeless. They have an objective, which is to bring inflation down to 2%. That's the target. But I think that's mission impossible for the foreseeable future. But that doesn't mean that the Fed is not going to try very hard. And more specifically, it doesn't mean that Jay Powell is not going to try very hard. So what do I mean by this? I think to understand what the Fed is going to do, you need to be cognizant of two things. Number one, before the hiking cycle started, Jay Powell told everyone that Paul Volcker is his hero. It's very important. I will come back to that in a second. Paul Volcker is his professional hero, he was telling at a congressional hearing. And the second most important thing is this Jackson Hole speech that he delivered a month and a half ago. So let me start with Jackson Hole. That wasn't really a speech, it was a memo. I can't really remember the last time a central bank governor at an event like Jackson Hole delivered a memo. I mean, central bankers usually go to Jackson Hole and Sintra and all these places and they deliver long, boring speeches that run 20, 30 pages long. And, you know, us in financial markets, and if you're an economist, you have to kind of like put yourself through reading 30 pages, another 30 pages of central bank speech. This time around, it was short and sweet. And that's very important in the context of what I'm going to say. I mean, a number of you are professionals that work in big institutions. So, you know, when you write a memo, what you put in that memo is just as important what you do not put in that memo. So what Jay Powell did not talk about is the most important thing. There's not one reference in the Jackson Hole speech to asset prices or to risk assets. Meaning the Fed put under stocks or credit or whatever is dead. It doesn't exist. You know, like ever since 1987 and Greenspan, you know, we had the Greenspan put, and then we had the Bernanke put, and then we had the Yellen put, and all these puts, the Draghi put. Not now. You know, the singular, the most important objective of the Fed. The Fed has like three objectives. It's like a three-legged stool. Price stability, full employment, and financial stability. You know, as I like to say, if you're a working parent, you can't do 100% at work. You can't do 100% washing dishes, and you can't do 100% on a tennis court because you can't. You know, you gotta chase babies and you gotta help your wife, and you have to do things at work. And at any moment in time, you know, it's 110% here and 90% here and 90% there, and hopefully not less because then you're in trouble. But you gotta balance. You can't do 110% on everything. For the Fed, they need to do 110% on inflation right now, and everything else is going to suffer. As I said, that Fed put on the risk assets is completely dead. When you read the Jackson Hole speech, there is reference there to higher unemployment, below trend growth, and economic weakness. And so that means that a recession is very likely. The Fed is not going to shy away from it. But their singular and most important objective at the moment is to bring inflation down to 2%. Not 2% on average over the next decade, 2% yesterday, as soon as possible. This is very important because we need to make sure that inflation expectations don't get unanchored. So that's the goal. And that's what Jay Powell is trying to accomplish. Going back to Jay Powell saying that Paul Volcker is his hero, why is that important? It's important because the reason why we have this notion that's called central bank credibility today. The reason why we trust central banks, even if we have all the reasons not to trust them, because all sorts of bad things happen on their watch. And, in retrospect, they always kind of don't do the right thing, whether it's financial regulation before the great financial crisis or overstimulating the economy and printing too much money before the war and during the pandemic, what have you. Again, the reason why there is central bank credibility is because of Paul Volcker, because of his achievements. So if you are a sitting central bank governor and you say that Paul Volcker is your hero, you basically are telling the market that I'm not going to do 100% of what he did, and I'm going to do 110% of what he did. And if I don't do 110% of what Paul Volcker would have done in this same situation, I will damage the credibility of central banks for a generation to come. And if you're Jay Powell, and if you're looking to retire in a couple of years, I think 5 years or so before his term is over, the last thing he's going to want is to retire with this burden of him being responsible for not trying hard enough and him being responsible for destroying central banks, central bank credibility globally for the next generation. Because, where the Fed goes, other central banks follow. So you're the leader of the pack, so to speak. So you got to be very aggressive. Everybody else is just going to mark to you. But if you're not aggressive enough, you will damage all of Paul Volcker's achievements. And then it's going to take decades for central banks to regain that credibility. Which means that if you kind of take a step back and you think about the Fed's reaction function from here, is the Fed going to over-tighten, overkill the economy to try to bring inflation down to 2%? Is that what they're going to do? Or are they going to put on a velvet glove, and are they going to treat the economy kindly, and they are going to kind of treat risk assets and credit markets and the stock market kindly and not raise rates too much? God forbid stocks fall another 20%. I think the risk is definitely on the first scenario, not on the second scenario. There is no safety net under stocks and risk assets. There is no safety net for unemployment. There is no safety net for a recession. I don't think, unemployment would have to go to a very high level and a recession would have to be very deep before the Fed would start thinking differently about rate hikes. I think we need to stop thinking about, we should start thinking, that's exactly what the CPI report was telling us yesterday. Is it going to rapidly decelerate to 2%, like the market assumes? Is it going to rapidly decelerate over the next 12 months as the Fed forecast, influencing the way the market thinks about inflation? Yes. Back to the original points I made about basis dislocations and simple ways of fixing basis dislocations. Is this thing gonna mean revert quickly just because we are hiking rates and shrinking the balance sheet? No. Okay, that's the big disconnect. The market basically assumes inflation is going to rapidly decelerate, and the Fed and the market is basically telling us that the biggest outbreak of inflation in the past 50 years, we are going to arrest with a hiking cycle, where the peak of that hiking cycle corresponds to negative real interest rates. Unless, of course, you think that inflation is going to rapidly decelerate from here to 2% over the next 12 months. And if that's true, I think we are all going to quit our jobs and we're all going to go back to school and relearn economics. I'm being sarcastic, but as I said, disinflation is something that's fundamental. It's driven by supply side shocks on multiple fronts. And this is not going to decelerate very rapidly. So again, in terms of what the Fed is going to do, how high they are going to have to raise interest rates, and how long interest rates are going to have to remain high is entirely simply a function of the path of interest rates of inflation from here. If inflation accelerates from here to 10 to 15%, the Fed will have to hike more. If inflation fails to decelerate, I think that's a pretty optimistic scenario. If it fails to decelerate and it just coasts around at 6, 7, 8%, the Fed is going to have to raise rates to 6, 7, 8%, twice as much as what the market is pricing. Is the Fed going to hesitate going there, given what Jay Powell said about Paul Volcker and the 2-page memo that he delivered at Jackson Hole? No, the Fed will not hesitate. They will go there. Is the market pricing something like that? No. Is more pain coming? Yes. Should we count yet? Not yet. Should start counting when things get to 5 to 6% and 6% plus. But that's a very real scenario. Okay, now I'm going to the third set of my remarks, which is, what's inflation gonna do? How do we think about that? So let me offer a few observations here. As I said, this is a crisis unlike anything that we have seen since the 80s, unlike anything that we have seen since the Second World War. I mean, any person that's reasonable, should see parallels between the interwar years, between First and the Second World War, and today. It's a scary world we live in. We basically have a return of great power politics, and the economic relationships and military kind of conflict or not between great powers tends to be driven by what people call the theory of trade expectation. If great powers are trading with each other and they think that their trade relationships are net positive for both sides, they are at peace. If they think that great power relations and trade and commerce is not a net benefit for everyone, they go to war over resources, over markets, over technologies. That great power conflict today is between the US and China. That conflict has been simmering ever since the trade wars under President Trump. And then, today China is a strategic adversary of the United States. And I think the most important and the most visible front there, where things are being fought out, is the technology embargo that the US is putting around China. And this is something that I think anyone in financial markets or finance has to follow very closely, because the US is building a very tight technology embargo around China. China cannot access by now cutting edge chip making equipment, cannot get its chip making facilities upgraded, and it cannot buy advanced chips for its AI systems, which, by the way, the party is building out a social governance system around AI. So this is very important. It's very fundamental. The U.S. in 1941 put a blockade around Japan. This was an oil blockade. Japan couldn't access oil, and that led to simmering tensions that led to a couple things a few months later. Today, think about the technology sanction similar to that oil embargo around Japan in 1941. People jokingly say that chips are the new oil. If that's true, we should be afraid. Think about the conflict between the US and Russia, which is being fought out in the Ukraine. Again, another scary situation. Think about the energy embargo that Europe is in with regards to the lack of gas coming from Russia and civilian infrastructure getting attacked, given what happened with the Nord Stream pipelines. You have basically what we could refer to as a stranded continent, potentially with stranded pieces of industry that have competitiveness issues going forward simply because energy prices are very high. Think about the tariffs that the US is considering putting on Russian aluminum. Russia produces a lot of aluminum. Europe used to produce a lot of aluminum, but not when energy prices are this high, because it's a very energy intensive process. So think about what that means for the supply side of things. I did talk about commodities being underinvested everywhere. Think about an economic war between Russia and China, and I would say, pretty much BRICS plus the global South. I mean, when you think about the decision of OPEC plus, when you think about Russia's decision with supplying gas to Europe, think about the sanctions, which all touch basically commodities one way or another. Think about the technology sanctions that I just mentioned between the U.S. and China. Think about zero COVID policies, which is just a war on COVID in China to deal with that situation, but that also has ramifications for supply chains everywhere. I mean, as a reasonable person, just take a step back and ask yourself the question: is this good or bad for inflation? If I had to explain this to my 7-year-old daughter, when you explain things to a child, you always have to simplify and like stop abstracting and assuming this, assuming that, base effects and whatnot. Yeah, just listen to your gut. Is this more inflation or less inflation? It's more inflation. Geopolitically, is the world becoming a safer place or a murkier place? It's becoming murkier, more dangerous. More inflation, less inflation, more inflation. Recession coming. It's bad for demand. Should be deflationary, right? Well, assuming supply is static, but it's not. It's coming inward. Is that inflationary or deflationary? It's inflationary. So I think we should stop kidding ourselves. The market, because you're running a lot of assets, a lot of risk assets, and you're running a lot of leverage, which you need to finance. You can't not think that the Fed is about to peak hiking interest rate. You can't not think inflation is not about to peak. Because if you don't think that, your portfolio doesn't work. That 60-40 portfolio just doesn't work when interest rates are going to go to 6 or 8%. It has a problem. So, inflation is going to be a big problem. I think I'm starting to run out of time here, so I think I will wrap up my remarks in a minute or two. Let me offer a few thoughts about what we need to do in the West to put ourselves on a deflating environment again, so that inflation is not as big a problem. I think the answer there is pretty short. I think we used to have a globalized world, which is fracturing. Going forward, we will have two big blocks. There will be the G7, and then there will be the BRICS. And the global South is going to kind of gravitate toward the BRICS. And so it's one block and another block, and everybody is doing their own thing. And these two blocks trade on the margin with stuff that, they don't have and they need to absolutely trade with. And we need to build that world. That world doesn't exist today. What this means for the West is, I think the West priorities are going to be 4 things: rearming, reshoring, restocking on commodities and just inventories of things in general, reinvesting in commodities, and rewiring the grid, just a euphemism for energy transition. So we will have to do all that. And that's going to take a lot of commodities. So commodity prices are going to rip. I'll come back to that in a second. It's going to take a lot of capital. It's kind of matter of life and death, national security, resilience, self-sufficiency. It's not going to be interest rate sensitive. Interest rates can be increased to 10%. If the Fed has to raise it to 10%, they will have to raise it to 10%. But that's not going to reduce the governments and corporations' willingness to borrow to build factories at home and to develop rare earth mines and rare earth refining facilities in the United States if they have to, because it's not coming out of China. And none of this is going to be investable by the global East, i.e. the BRICS countries. Just think, in the context of China, because it's, you rearm against me, you reshore your supply chains against me, you are building stockpiles of commodities against me. I'm not going to finance that for you. So if I have $1 trillion of treasury securities today, I'm just not going to show up at your auctions, because if I do, I effectively finance you doing all these things against me. So this is a breaking point in history. And again, to pull all this off is going to be very inflationary again. So not only do we have this, we had supply shocks, demand is too high, we need to slow in demand down to kind of curb the inertia and the impulse of inflation that we're dealing with now. Becoming self-sufficient and doing all the rearm, reshore, restock, decarbonize things is going to be inflationary itself. So inflation is with us for the next 5 to 10 years, I think. 2% is going to be very hard to attain. Once we are done with all this stuff, and once we have a world where they have capacity to produce there, we now have capacity to produce here, then everybody's going to be in surplus again. You know, inflation is going to slow down, but that's like a 2032 thing. Yeah, that's when inflation is going to come down, like it started to in the 1980s, because it's going to take a decade for the Fed to have the kind of backdrop that Paul Volcker was blessed with. Right? I mean, he had a decade of investments in commodities. And then maybe the final remark I would say here is, what does this mean for interest rates, for yield curves? I mean, yield curves tend to invert all the time. Yield curves are flat. Yield curves are not upward sloping. You know, if you take your CFA test and they ask you like, what's a yield curve? You know what a yield curve is. What's it shaped? It's upward sloping. Why? Well, because tomorrow is more certain than 10 years from now. And so there is a premium for that. And so again, ask yourself the question, 5 to 10 years from now, is the world more global or less global? More friendly or less friendly? If the answer is less global and less friendly, that means more inflation. If there's more inflation, the curve should be upward sloping. Today, it's not. So we have a long journey to kind of regain that positive slope. I think as we are on that journey, we will deal with a lot of issues in terms of demand for government debt issued by G7 countries. I mean, I think the UK is a beautiful example of all this. I think the US is not immune to events like that, where you basically have a buyer's strike. I think if you look at the treasury market today, basically the Fed wants to step away because they are shrinking the balance sheet. The PBOC is stepping away because of what happened to Russia's FX reserves, and they just don't want their money to get stuck. The Japanese are intervening in the FX market, and so they are selling treasuries too. And so I think shrinking the Fed's balance sheet is mission impossible. We will have this cyclical demand issue. We will have a cyclical supply issue. I mean, eventually we will fall into a recession, and that means that the deficits are going to increase and the government is going to have to issue more. And then we will have to finance this rearm, reshore, restock, continue with energy transition thing, which is going to take a ton of money too. And when all these realities hit, I think yields are going to move higher. It's going to push the curve into a positive slope as opposed to this inverting tendency that we have. And then the Fed is going to restart QE. We're just going to do it on the guise of yield curve control, you know, which is going to keep the purpose of keeping yields from going too high, much like the Bank of England. And what does this mean for countries like India? Look, I think India is a great trading nation, and India's history is full of instances where you're walking a knife edge and kind of on both sides, and you're trying to stay neutral. And I think that's what I see from India these days. Let me just offer one little thing to kind of infect your mind. I think EM, they use the emerging markets. EM to me is starting to mean, in the context of some countries, emancipation. So EM is like emancipated markets. Let me just offer you two good examples here. India and Russia are buying cheap. India and China are buying cheap Russian commodities at the moment, and you get to pay with rupees and renminbi for it, respectively. So that's a big deal, because if you end up in a world where the commodity trade is not just dollars, but other currencies too, like the rupee, and you get to pay for your commodities to Russia in rupees, you no longer have to sell rupee to buy dollar to import your commodities. If you expand that to all other commodities and all other commodity exporting countries, that's a big lift to your currency. And I think we are at the forefront of that. I mean, when you look at G7 currencies versus the dollar, performed very bad. When you look at the rupee's performance to the dollar, or the renminbi's performance to the dollar, or the ruble's performance to the dollar, it's a very different story for a very good reason. So again, I think this is a very unique period. This is a shifting balance of power in the world from the G7 to the BRICS. I think this is a story that's going to long for a very long time. And we'll see how it evolves. But hopefully my speech today gave you a nice little framework to think about some of these things. I'll stop there. We have 4 minutes for Q&A, unfortunately.
Yes, I think that unfortunately we're just about 4 or 5 minutes for Q&A. So Zoltan, thank you for that overview. And I suspect that you've answered many of the questions that I had and many of the questions that have come in from the audience as well. So let me try and condense all of that into just 2 questions that I'll put to you up front, because I know you have a hard stop in terms of time. I think one, you did touch upon what all of this means for emerging markets like India. But let me nuance it a little bit more based on your August note. You've spoken of an L-shaped recession in the West, at least. You've said that's going to mean that the West will have to start living more thriftily. The super size me mentality will have to go away. You've touched upon protectionism, nationalism, nativism, all of that coming back, a version of deglobalization in some ways, right? Now, yep. All of these were things that were driving growth in the emerging markets, the consumption of the West that helped China increase its per capita income in ways that one would have never imagined, or that what India is now hoping to be able to ride on in terms of its manufacturing sector. If that's going to change, what does growth for the emerging markets look like over the course of the next decade?
Well, again, I think growth, I mean, this is a transition, you know, without a doubt. I think, you know, if we have these 2 blocks and both of them are kind of trading with themselves, you know, so to speak. I mean, what this ultimately means, I think, in the context of China is that, you know, consumption growth at home has to be supported. You know, you will have credit policies, you know, you'll have consumer credit, because naturally, if we kind of just go with the reshoring theme, you know, I mean, a lot of that production that happened in China is not going to happen in the US. Okay, so we are going to make our own stuff. China will end up with excess capacity. China will have to find ways to soak that up. But I think this is where the Belt and Road Initiative is coming in. I mean, that's the idea for the post-global world order. You know, we used to produce for this market. Now we are going to produce for this market. You know, people are not as rich, but, you know, we can make them rich. You know, there is consumer credit. There is more domestic everything. You know, reshoring is also going to mean friendshoring. And, you know, to the extent that India can secure, for example, some of these shoring movements, great, you know. But again, I think it's clear who the friends are and who the non-friends are in terms of friendshoring, for example. India is a friendly place, so I think you're going to benefit. You know, the chip sector is at play. I mean, you know, if you invest in chip foundries, for example, because Southeast Asia is now a murky place that's very geopolitical, that's, you know, blackmailable via the straits, you know, maybe India is a much better place for, you know, TSMC and Intel and whoever, global foundries to build stuff. So again, there will be winners and losers. There will be EM countries with a lot of commodities. You know, some of these EM countries are going to choose to play resource nationalism. Some of these countries are going to choose to sell their commodities in terms of their own currency. You know, because look at the ruble. I mean, it's one of the best performing currencies. for a very good reason. You have a lot of commodities and you price those commodities in your currency. So again, I think, you know, we all have to do our homework in terms of, you know, EM is not a homogeneous group. There will be winners, there will be losers. I think playing it smartly, you can be a very big winner of this. And again, I think, you know, some EM countries are going to boost their domestic consumption by a domestic credit. So they're going to look a bit more like the US on a 20-year horizon. Some are going to benefit from the commodity aspect. Some of these are going to benefit from the friendshoring aspect. But again, we are redrawing the world. You know, this is a time when the political maps are getting redrawn. So if the political maps are getting redrawn, the economic maps of globalization are going to get redrawn too.
Okay, great. My last question, and I'll build up to it a little bit just to set the context. One of the members of the audience sent in a question that reads, how long will it take for the world order to normalize? And, you know, when I was reading it, it struck me that all your notes through the course of this year have not suggested any return to the normal as we knew it, right? Yeah. The last one says, welcome to the war economy, where heads of state matter more than heads of central banks. And in effect, that means we are set for more unpredictability than we have seen in the last 2 or 3 decades, because politics does not work in the same frameworks that central banking does, where things are more predictable, right? So the final question to you, before you answer that, final question to you, which I'm sure is the question in everyone's mind in the audience, what does all of this mean for portfolio construction over the course of the next decade? How do you approach that?
Okay, so 2 quick answers, and then I'm going to have to go. First, you know, what was kind of abnormal, you know, world peace, unipolar world order, globalization, whatnot. So that was kind of abnormally good and peaceful and great, very efficient, very cost effective. I don't know. I mean, you know, world wars last 5 years and then you reset. So hopefully it doesn't come to that. But I think we are going to need at least 5 years to kind of redraw the economic world order. Let's just put it that way. First. Second, and I will be very brief about this because there is nothing more to say about it. I think 60-40 is dead. Commodities need to have a very big part in your portfolio, as well as cash. You know, cash is now an asset that yields well, and it has option value. When there will be discounts on good assets, you need cash to basically be able to buy those good assets for the long term. So I think 60-40 needs to be shrunk down to 50% of a portfolio, and the other 50% should be cash and commodities. Again, we are going to have a commodity super cycle here. I think demand for commodities is going to be through the roof. Supply is constrained, so there's not much we can do in terms of digging out more from the earth or pumping more from the earth. And resource nationalism is creeping in, so the supply you think is there is actually not, because it's going to go east, not to the west, which means much higher commodity prices. So commodities are an asset class, and you need to find ways to get exposure to it. You need to own the periodic system, so to speak.
All right. I know you have a hard stop. I know there are a dozen more questions, but thank you for the worldview according to Zoltan Pozsar. And thank you to the audience members as well. With that, I'm going to hand it over to Ravi at the CFA Society again. Zoltan, thank you.
Thank you very much. Best of luck to everyone. Bye-bye.